Well, good afternoon. It's a pleasure to be here today. What I'm going to try to do today is give you some big picture ideas about where we are in the agricultural economy. Unfortunately, things have turned around in the last year or two, and I want to try to put them into context, but I want to try to do it in a simple way and try to show you that there's some really important demand and supply situations that have been going on here, both in the corn and the soybean and wheat markets, and you're going to see some charts that resemble a similar pattern across each. Let's start with US farm income, and the USDA just most recently came out with their forecast numbers for 2024, and they were pretty shocking. I want to say from the outset, when the USDA puts out these numbers initially, they tend to be downward biased. In other words, they start out with not so pretty picture and it gets better over time. So put that into context. But let's start from a baseline of 2022 and I want to focus on cash income for a minute because that's about cash receipts. In 2022, we had a record net cash income of $202 billion, okay? And cash receipts were $536 billion. So it turns out since 2002, when you compare 2002 to 2024, cash receipts are down about 10%, okay? That's 2 years of projected declines of 5% and 4% on cash receipts. Crops are down about 12% versus livestock at 7%. So if there's a bias there, currently the USDA is projecting the reduction in crop income is more than the animal situation. Also, I want to point out that the government payments continue to decline. Back in 2020, when we had trade wars, we're at $45 billion. We're back now to 10. So these income projections basically reflect markets apart from the usual programs that we have in there. And so the bottom line is cash expenses continue to increase, up 2.6%, 3.7%, to a total of 6.4%. So if you've got cash receipts coming down and expenses continuing to increase, results in about a 40% decline in net cash income. When you look at the farm income, it's about 38%. So not a rosy picture going into 2024 on net farm income. We're 2 years out from a record. We've had essentially 2 years of reduced income. This next chart is something I like to show because basically what I want to be able to show here is we like to have this cash expenses line. It's upward sloping, but we want the slope on the blue line to be greater, which reflects that your net cash income is outstripping expenses. And I want to point out particularly 2022 when we were on a really good projectile. But what's happened, it's the cash receipts that have let us down in terms of keeping that upward projectile, and now we're basically, those two lines are parallel, which means that we're just handling about the same amount of net income on average over 5 years. Net income isn't going up. But this can change pretty quickly, but what we need the growth to come is from cash receipts, and we need to keep a lid on expenses, okay? I now stole a few pictures from the USDA. They have access to the good data. And I just want to point out a few things. These are inflation adjusted numbers for years, for the last 10 years, economists, we didn't care much about inflation because it was running at 2%. But in the last few years when we've had all this inflationary pressure, inflation really matters because we got it up to as high as 8 and 9%. And for some of our agricultural inputs, it got as high as 20 and 50%, okay? So these are net adjusted cash income on farm income And they show, as I've already pointed out, that the farm sector's income continues to fall in 2024 after record highs in 2022, and this shows net farm income and net cash farm income. But the most important thing about this chart is the second point here. It shows that in inflation-adjusted dollars, both income measures are below the 20-year average. That's not good. Okay, so when we take into account inflation, 2024 is projected to be below our last 20 years average. So when you look at the same chart, but now we just focus on cash receipts, we see that cash receipts have declined, as we already talked about, and the total inflation-adjusted cash receipts are forecasting to fall by about 32 billion, or 62%. That's in 23 over 24. Cash receipts on crops are forecast to go down 8.3%, and cash receipts for animals are projected to decline about 4%. Again, crops are taking more of the hit versus animals. When you look at individual crops, and this is a comparison of 22, 23 and 24, on the left-hand side here you can see in 2024 the two crops that are taking the major hit on cash receipts are corn and soybeans. Okay, cotton is down a little bit from 8.4 to 7 over the 2-year period, and fruit and nuts, vegetables and melons and wheat are about up after the decline in 23, they're about the same. So cash and soybeans on the cash receipts, they're the ones worst hit. In terms of animals, the cattle and calves are actually up. That's because there's a shrinkage in the herd size, and so prices have gone up. After 2022, dairy, broilers and hogs are all down, as well as eggs. Okay, so it's pretty across the board, with the exception of the cattle and calf industry, with an emphasis on corn and soybeans. Okay, and we've got a lot of corn and soybean producers in this room. So this is about as simple as I can try to make it, but I want it to be made simple because this is where the demand and supply comes in. So what I've shown here in this chart is I've compared two things: average farm price and ending stocks in corn, soybeans and wheat for the last 3 years. So in 2022, we had a reduction in ending stocks in all three commodities: corn, soybeans and wheat, with wheat being the most significant. And because of that reduction in ending stocks, and we already are at tight levels, we had increases in prices of 9% for corn, soybeans 6.8, and wheat was up 15.7. That was the record-setting year, okay? Lower ending stocks, higher prices. And I'm going to talk about demand rationing here in a minute, but what happened in 23, 24, we had significant demand rationing because of higher prices, but we also had a pretty good production year. And with higher production, reduced amounts of demand, we've now got fairly significant increases in ending stocks. Corn's up 60%, soybeans are up 19%, and wheat's up 15%. That, in essence, is why we're seeing a reduction in the commodity prices, double digits, all three are double digits. Corn's down the most because the ending stocks are up the most. Soybeans down 10%, wheat's down 18%. So it's demand and supply. And it took a couple of years to get here, okay? Remember, in agriculture, in corn and soybeans and wheat, we only have one chance to make the production. We have all year to ration demand. And we've done a pretty good job rationing demand. And by rationing demand, I mean prices go up so people buy less so we don't run out. okay? So let's take a quick look at the balance sheet on corn. And so what we've got with corn, the bottom line is we end up with a 26% reduction in ending stocks. Sorry, a 26% decline in price and a 60% increase in ending stocks. So how do we get there? Well, we had a substantial increase in acres in 23, bouncing back from 2022 when the fertiliser prices were so high and energy was so high. So with 7% more acres, a 2.2% increase in yield, we had a fairly significant increase in production of 12%. Ending stocks, beginning stocks were down slightly, but we had an increase in supply of 11%. But you need to look, in 2022, we had a significant increase in price from $6 to $6.54. That did a pretty good job rationing demand. And so exports were up 26%, but feed and ethanol demand were only up 3 and 4%, which meant that total use was only up 6%. That led to a fairly substantial increase in ending stocks. And so this is a really important chart to show the demand rationing, and you're going to see this chart not only in corn, you're going to see it in soybeans. And I want to go back to 2019. So in 2019 we had ending stocks at 1.9 billion, okay? Had significant, and corn was 356. At 450 corn in 2020, demand was substantial, okay? Reasonable production year, more than 2019, but it really took a toll on ending stocks. So prices went up to ration demand because we didn't want to run out of corn, okay? 2021, we've now got $6 corn, had a pretty good production year, better than the previous year, so fairly much higher, but now ending stocks remained at 1.3 billion, okay? But we did such a good job rationing demand at 654. Look where demand was in 21 and 20 compared to what it was in 2022. And we had a reduction in production in 2022. And so in 2023, when we come along with a really good crop and prices were high for most of the marketing year, that's why we end up with this ending stocks of 2.1 billion. Okay? So it just didn't happen overnight. So we successfully rationed demand, then we have a good crop, now we've got plenty of corn. Okay? So you can see where we are on average. We're above average now, and so we're at a comfortable level in the corn market, and that's why we have prices where they are. Okay? Now keep this in mind because you want to remember what this is compared to soybeans. Okay? So typically we like to keep about 1.6 billion bushels in reserve. Right now we're at about 2.1. Okay, so there's a bit of room there to move if we have either a weather market or a reduction in yield. There's still some corn in reserve that will stifle any increases in prices that might happen this year, and we want to keep that in mind. Is it all about the US? Not really. So without getting into all the different countries, I went and had a look at what's happening around the world. And it turns out that global ending stocks are also increasing. So global ending stocks in 2023 versus 2024, up 8.3%, okay? So it's not just the US has got more ending stocks, so does the rest of the world. When you look at it, there's different countries there, but when you average it out, the rest of the world's ending stocks are up by 8.3%. Remember, the US is the #1 producer of corn in the world. And so if there's a surplus here, that's going to contribute to the world, but also it's important to know who has ending stocks in the world. And I'll just point out that when you look at the US is the major producer and also one of the major users, but look at the amount of corn that China has in stock. Keep that in mind when we talk about export numbers, because what the Chinese do on exports is really important. This is something I want to talk about in relation to corn and soybeans. So in economics, there's an inverse relationship between stocks to use and price, okay? And we just talked about it in depth, but you can see from 2022 to 2023, we've got this substantial reduction in price with the fairly significant increase in ending stocks. That's fairly responsive, okay? Simple economics. There's excess leftover of corn, so there's a fairly substantial reduction in price. Keep that in mind when we look at the soybean chart that's coming up. So if we are able to reduce ending stocks again, that's where we'll see the price response, but it's pretty significant, okay? Let's turn to the futures market now, which I'm sure you're all watching. This is the important time where the market is sending a signal about what to plant in 2024. So this is the December 2024 new crop corn futures. And basically, since August, it's been trading sideways in a 25% range. And then in the new year, we saw a fairly significant decline where we gave up another 25 cents down to 4.75. 4.75 on the board means roughly 5.50 in North Carolina with a 70-cent basis. What we've done recently, we've found support at the $4.77 range, and it's been trading 4.70 to 4.80. So we've found some support there, okay? That's important. Keep this in mind when we look at the soybean chart where there hasn't been any support. But basically, hopefully there's some resistance here at 4.70. But remember, corn is competing for soybeans in acreage now. This is the month also where your crop insurance projected prices are being formed. So in the month of February, we're collecting this data right now. It's going to have the corn futures right around the 4.70, 4.80 mark. That's going to be your price on your revenue insurance. There's a formula we can use in economics where we can look at the volatility in the options markets and make some projections based on what we see in the futures about what prices might be in December. This is not Nick sticking his finger up at the moon. This is based on options pricing right now, okay? And so what I did is I took where the prices were last Friday, looked at the options premiums, and I said, what is the range that we might have on corn in December? Well, right now we're at $4.70. That's the market's best guess of where we'll be in December. It's the unbiased guess, and it is a guess, okay? But we're however many months away from December. It's a lot. What is it, 8, 9 months away? So there's a lot of uncertainty. So the probability that we'll get above $6.40 on corn this year is around 15%. So if you're looking for a price in the, so that would be at 6.50 on the board, that would be 7.25 in North Carolina. 15% chance, not very likely. The prices will go below 3.50, less than 18% chance. So we've got a fairly substantial range here of $3 between the 6.43 and the 3.53. What does that large range reflect? That there's a ton of uncertainty in the market, okay? What are the two biggest things we're uncertain about? How much we're going to plant and what the weather's going to be. They're the two key things. And they're the two things we want to monitor this year because it's going to be a tough marketing year. And they're going to be your chances to make some money this year. If we don't have the acreage we expect and whether the weather doesn't happen like it should. But if everything goes like it should, the market's thinking we got 4.70 corn, which is about 540, 550 in North Carolina on average. Okay, this next chart looks at new crop corn futures and compares them to the last 5 years where we are here. So this line here, the black line, is tracing out what we're doing right now. And like I said, this is going to be your crop insurance price for this year. But you can see in 2024, the December futures are below where we were in 2022, the year we had net farm income so high, and also 2023, okay? So we're below from where that started. But just because we're below, I want you to also look at what happened. Different reasons why this happened in 2022 and also 2021. For the prices to go higher here in the summertime, what happened? There was concerns about production, okay? Were we going to make the crop? Was either dry or one of those things. So keep that in mind, that just because you start out here, doesn't mean you can't get rallies in the market, and that's what we're looking for in 2024, because we're starting behind the curveball that we started in the last 2 years. Okay, and they were reasonably 2 good production years too. And I think in 2021, that was our record corn crop in North Carolina. Okay, let's turn to soybeans. And we gave up soybean acres for corn acres in 2023, so we started the year out with less acres. We had a good production year. Production was up 2%. So total supply was down about 2.4%. We also had demand rationing going on in the export market because we had really tight ending stocks, and so exports were down 13.7%. Crush was still at record levels at about up 4%, so total use was down 3.7%. So the demand rationing was successful in the sense that now we've got demand outstrip supply, the reduction anyway, so ending stocks are up about 20%, or 24%, or the stocks to use. So that reduced soybean prices by about 10%, okay? So this is almost a mirror image of the corn chart, but I want you to see, well, in the years where we had demand outstripping supply and reducing ending stocks, prices went higher. The prices go higher to ration demand, and you can see at 1330 demand the following year went down, and then at 1420 demand went down, and so that in part has led to the increase in ending stocks, but it's nowhere near as comfortable as where we are with corn. Okay, but again, demand rationing worked, and as prices come down, we expect demand to pick up now, and if we have a good production year, that will add further to ending stocks. Because as you're going to see in the soybean market, we're not quite as comfortable where we are on corn. We're still below the 5-year average with ending stocks at 315 versus we usually like to have 446 million in store. So immediately you should be thinking about, well, the corn market, we have got ample supplies over ending stocks versus soybeans, so soybean prices should be going higher relative to corn, so we get more soybean acres. And if you look closely, that's what the market's telling you, and that's where we're going to turn to now. But before we do that, I also went out and had a look at the ending stocks for the rest of the world. Similar story to corn. Ending stocks in the rest of the world is increasing as well. Now remember that the US isn't the #1 producer, South America is, but ending stocks in the United States are up 19.2, in Argentina are up 15.9, Brazil's down a little bit, down 2.8%, and the rest of the world's up 7.3. So ending stocks in the rest of the world are up 12%. So if we have a shortfall in the US, there's still some supplies around the rest of the world to make up for some of the reduction in our exports. Okay, so when we look at the stocks to use, remember corn was quite responsive when ending stocks went up. Now the ending stock increase in soybeans is not as dramatic as what is in corn, but nor is the reduction in price. We're still at pretty low levels of ending stocks for soybeans, and so we don't see the pullback in price as much, okay? And so this is a signal that the price of soybeans is a little higher than the relative price of corn, which is sending a signal to the market on the margin to plant a few more soybeans versus corn if you can do that, okay? It's not always 50-50 in the Midwest. There's some wiggle room with a few million acres we see every year. And so right now the economics is pointing towards more corn. More soybeans, sorry. Which is interesting because when you look at the soybean chart, it also traded sideways from August onward between 12.40 and 13.20. And in the new year, like corn, it's been pretty much in, not a free fall, but it's been declining consistently, giving up about another 75 cents, but it's still looking for support. Remember, corn's found support now. And so the interesting thing is, what will the bean market do now to make sure it gets the acreage it needs in 2024 to make sure we've got the ending supplies we need in 2024 to be more comfortable on that average price, okay? Let's look at the probabilities like we did for corn. The market's best guess is that corn will be 11.64 in November. And again, there's a fairly large margin around this. 14.73, higher than 14.73 with a probability of about 14%, and lower than 9.58, about 19%. Another fairly substantial margin there of about $5, again reflecting the uncertainty. Not surprising that the chart for new crop soybeans looks a lot like the new crop for corn, where we're starting off 2024 below where we were on 2023, and also, but above where we were on 2022. Remember, 2022 went on to be a record year. So even though we're starting just above there, we're beginning to decline, or this gap's getting bigger. And this is where we should see in the last part of February and March, if we're going to get the soybean acres, that soybean price needs to increase relative to corn to get that bid for those acreage, the marginal acres, okay? So I won't spend too much time on wheat, but wheat's a very similar story in terms of ending stocks and price. We had more wheat acres. Acres were up 8.3%. A good production year, up 4.5% in yield. So total supply was up 3.3%. We had significant demand rationing in wheat. Prices were $8.83 in 2022. And so that higher price did a good job rationing demand. Demand dropped 0.4%. Despite there being a lot more wheat being fed, that was up 55%. And so ending stocks are up 15% in wheat for a reduction in price of about 18%. Now this is milling quality wheat, it's not feed wheat, but we see similar trends. And I'll skip over this quickly. You see the demand rationing story in wheat, similar to what happened in corn, especially right here between 2020 and 2021. again in 2022 when production was significantly below demand, until finally we got production up where we needed to be with the increase in acres. So not only are rationing demand, when prices go higher, they're also a signal for growers to plant more. And so that's what happened here in wheat, okay? And so ending stocks have gone up a bit, and when you look at where we are historically, ending stocks in wheat are also below their average, but the percentages are much higher, so it's not as fragile as what it is in corn and soybeans, plus wheat's grown all over the world, which changes the economics significantly. You can see the responsiveness of wheat price to ending stocks falls somewhere in between where we do on corn and soybeans. There's a response, but it's not as dramatic as what we saw in the corn market, and it's not as modest as what we saw in the soybean market. That's partly again because wheat's grown all around the world. On the futures, wheat basically has been trading sideways in about a 60-cent range. It's looking to get out of that range with most of the momentum, as you can see. One of the really important things to look at this time of the year is how the new crop soybeans is trading relative to the new crop corn. And so what I've shown you earlier is, as of last Friday, new crop soybeans are $11.64, new crop corn is at $4.68. That ratio is really important. Long term, the new crop soybeans over the new crop corn is about 2.4. And when that ratio is above 2.4, that's a signal to plant soybeans. Right now, that ratio is 2.48. So that's a signal to farmers right now on the margin that to plant more soybean acres in 2024. So soybeans are slightly more profitable than corn at the current prices, okay? However, remember, we've had the soybean market pretty much in free fall, and the corn market has put in a bottom somewhere around 470. I expect in the next few weeks we should see soybeans rally somewhat to make this more decisive, to get more soybean acres, and the reason is it's the ending stocks between corn and soybeans. So it's simple demand and supply. It's not a conspiracy theory or anything like that. The market we should see soybeans rally, which will give farmers enough incentive to want to plant at the margin some more soybeans. So keep abreast of what that ratio is. Look at the two contracts and see if it goes below 2.4, that's a signal to plant more corn. So that might happen if soybeans continue to decline, but given they're the ones with the smallest ending stocks, I don't think that's likely to happen. And so there was one thing that happened, and so what I did is I went back and looked at the 2004 contract since 2003. And so here you have soybeans, here you have corn, and the ratio here was right around about 2.3 for most of 2003. And then something happened right around June where it jumped to up to 2.6. So I went back and had a look at what happened in 2023, and this jumped when the corn acreage report went up 6%, that confirmed that corn acres were up 6% and soybeans were down 5%, okay? Why is this important? This is really important because this is tracking out for you another pricing opportunity potentially in 2024. And we'll talk about that some more, but this is just to show how these markets are responsive to information out there. But I will say with the USDA reports, sometimes it's slow to get the truth out. So it might take 3, 5, 6 months. They tend to move slowly and they like not to move much off where they were the previous month, so it takes a while. When you look at the ratio of the new crop soybeans to corn and compare where we were to other years, you can see in 3 of the past 5 years we're right around 2.4, which was calling for not a significant increase in acres. And in 2021, when we needed more soybean acres, it was 2.6, and right now we're about the 2.5, okay? So there's not a lot of information in that. Just quickly, I pulled up the basis numbers for January 2024, and these are immediate basis numbers, basically basis on old crop for January 2024. And so on old crop corn, we have basis at elevators somewhere between 75 cents and as low as minus 25 cents out in Elizabeth City. At the mills and processors, it's somewhere between 75 cents and 6 cents, depending on the location. The soybean basis right now is in the negative, okay, at most locations, down about 40 cents. And for the mill, at country elevators and mills and processors, it's somewhere between 30 cents and 0. And old crop wheat has a basis somewhere around $1.20, okay? When we look at harvest basis, which is the basis you could lock in for 2024, at corn at the country elevators, it's somewhere between 55 cents and as low as minus 32 cents. At mills and processors, it's about 60 cents. Country elevators on soybeans, minus 10 cents. And the mills and processors are paying about 50 cents at both Selma and Fayetteville. So I expect the basis there to strengthen on corn. We should see that around 75 to 80 cents later on the year. And the mills and processors are about where they typically are on soybeans. I wanted to do, a couple of years ago, the corn growers sponsored a project where I was able to build this substantial database of basis, and one of the things I am interested in learning about is what's happened to basis over the years, okay? So as an exercise, what I did is I took an average of the last 5 years, the last 10 years, and the last 20 years for corn basis in Rose Hill. So this is 5 years over the year, 10 and 20 years. What does that show you? It says over the last 20 years, corn basis has continued to increase. On Rose Hill, it's on average increased about 8 cents per bushel, comparing the 5 and 10 year. And comparing the 5 and 20 year, it's increased about 25 cents, okay? The corn carry, however, in the basis, and that's how much the basis increases from October through the marketing year. It's stayed relatively stable, and it increases around up to 20 cents to January, and then after January, the basis doesn't typically pay to store, okay? At least on average in Rose Hill. Did the same exercise for soybeans at Fayetteville, and we can see soybean basis has actually increased more relative to corn. Basis has increased 13% on average, comparing the 5 and 10 year averages. It's been 24 cents comparing the 5 and 20 year average, and soybean basis carry increases around 60%, about 60 cents up to July before it levels off, okay? So basis is increasing in North Carolina, which we would expect given what we've had with some of its inflation, but also the increase in demand for feed grains from the livestock industry. But it probably hasn't increased as much as I had anticipated, okay? I wanted to touch on briefly a couple of tools that we have available. I'll make these slides so that you can get the links, but I want to remind everyone at the grain marketing homepage, we've got lots of tools out there. One is our budgets. The budgets have been released for 2024 that Derek Washburn does, and I encourage you to use those. They're a template. You can put in your own cost of production, your own yields. It basically gives you a spreadsheet so you can then look at your costs, your revenues, and compare it to our baseline we have in the state. There's also the historical corn, soybean and wheat price basis data that I maintain. That's kept up to date as of January. Very helpful in trying to make decisions when you're trying to evaluate a particular basis offer. And then next week we're going to release the crop comparison tool. We've had it's taken a bit longer this year because of trying to get some information back from farmers. This is something Derek Washburn and I try to produce every year, where you can compare crops side by side and their relative profitability. So those tools are out there. So a few final thoughts. That is that the farm sector is forecast to continue to fall in 2024. It's not going to be a 2022. It's going to be a repeat of 2023 with further reductions. Total cash receipts are projected to decline for a second straight year. All corn, soybeans and wheat prices are forecast to be lower in 23-24 due to the higher ending stocks that we've spent a lot of time talking about. But let me focus on a couple of potential opportunities for pricing crops in 2024. There's two main USDA reports that could produce surprises that could be an opportunity for you to market your crop. The first is the prospective planning report that is going to be out on March 28th. If there's a reduction in acreage, which could happen with the substantial reduction in incomes, then we should see a positive price response. I think it was 2022 or 2021 when the prospective planning report I think it was on corn, the acres were down. We saw the market rally more than $1 and we kept that dollar. So March 28th is one. The second opportunity will be June 28th when the actual planted acreage is reported, okay? And if that actual planted acreage is different than the prospective plantings, think 2019, I think it was 2019 when it rained and we couldn't get the acreage planted, that provided a big stimulus to the market. And then finally, throughout the year in the Midwest, the crop progress and condition reports. If we don't plant the crop just like we need to, and if we have any hiccups in the weather, this is where opportunities are going to be to market your crop. And that's going to involve increases in the futures market that will be reflected in the prices that are offered in North Carolina, and you're going to have to contract. So the way to try to market your crop, so let me back up. If everything goes as expected right now, corn, soybeans and wheat prices are going to be lower this year than last year. So we're relying on some surprises, either reductions in acreage, reductions in yields due to bad weather for pricing opportunities. In particular, we want some weather impacts in the Midwest, but not here in North Carolina, okay? Happens about every 4 or 5 years, okay? So we're looking for that. But when we're in a market like this where there's a fair bit of momentum towards the downside, the best approach to marketing is selling or contracting grain when it's profitable on upswings, but do it in bundles, like 15, 20% of your expected production, so that on average, hopefully the last sale you made would be the lowest for the year, that you can potentially dollar cost average up into that, and try to avoid selling your crop at harvest, because if there is no surprises, then we're going to have the lowest prices then around harvest time. So that's all I have, and if I've got time, I'll take a few questions, but we may not have time.
If you had corn and beans in storage unpriced right now, how would you look at that?
Yeah, so the basis charts I showed that on corn it doesn't typically pay for an increase in basis past January or February. So short of something happening with the train and something you can't predict, it's probably time to sell that corn. On soybeans, the basis can continue to increase up until June or July. So that's the basis story, but most of the price momentum right now is to the downside, with the exception of the report that comes out at the end of March. If that provides an impetus to either corn or soybeans, that would be the decision time frames there.